What if I told you that the single greatest obstacle to financial freedom isn't your bank account? It is the fear holding you back. Today, video on From Book to Life takes powerful lessons from Rich Dad, Poor Dad, and turns them into a step-by-step guide you can start using right away, no matter your income. If you've ever wondered whether you need to be rich or a financial expert to start investing, think again. I'll show you simple strategies you can put into action with as little as $5 a week. No anxiety, no excuses. So, if you're ready to turn book wisdom into real-life progress, make sure to hit like, share your thoughts in the comments, and subscribe to join our growing community. Let's jump in and break through those barriers together. Breaking down the barriers of fear when it comes to investing is a crucial first step toward financial empowerment. Many people are held back by misconceptions that create invisible walls, preventing them from exploring opportunities that could genuinely enhance their financial future. These myths often stem from outdated ideas or partial truths that no longer apply in today's rapidly evolving economic landscape. It is important to closely examine these myths alongside the realities to better understand how approachable and manageable investing can really be. Take, for instance, the common belief that investing requires a large amount of money to get started. This notion can be intimidating, making many feel excluded from what seems like an exclusive club reserved for the wealthy. Yet, reality tells us a much different story. In fact, thanks to technological advancements and platforms designed for everyday users, you can begin investing with as little as $5. This shift has opened doors for countless individuals who might have otherwise felt they were too late or lacked sufficient capital to participate. The democratization of investing is more than just a buzzword. It is a fundamental transformation, reshaping access and opportunity. No longer is investing a playground just for the rich or financially elite. Instead, it is increasingly accessible to anyone with a smartphone and internet connection. This reminds us that while money can accelerate growth, the initial barrier to entry is far lower than many imagine. It's an invitation to explore, learn, and grow wealth step by step, rather than waiting for some perfect financial moment that might never arrive. Of course, fear of loss remains a powerful deterrent. The idea of risking everything has haunted many prospective investors, reinforcing a sense of vulnerability and uncertainty. Yet, it's important to recognize that investing does not have to be a reckless gamble. There are strategies specifically designed to minimize risk, allowing individuals to protect their principal while pursuing steady growth. Understanding risk tolerance and aligning it with suitable investment approaches can transform anxiety into confidence, gradually changing the narrative from one of fear to empowerment. Finally, another barrier often cited is the perceived complexity of the stock market and investment products. Historically, investing might have been confusing, filled with jargon and requiring deep expertise. However, today's digital tools have dramatically simplified this landscape. User-friendly apps guide new investors through the process, offering educational resources and automated suggestions that do much of the heavy lifting. This technological aid not only eases the learning curve, but also fosters a sense of control and understanding, making the entire experience more approachable. Reflecting on these contrasts between myth and reality, it becomes clear that many of the fears surrounding investing are more about perception than actual obstacles. The journey from hesitance to confidence is often paved with knowledge, accessible technology, and a willingness to challenge long-held beliefs. When these elements come together, they form the foundation for a more inclusive and encouraging investment culture, one where individuals feel empowered to take ownership of their financial destinies. This reframing opens up a conversation about how we can further dismantle fears and invite everyone to participate in wealth-building opportunities in meaningful ways. Building on the idea that investing is no longer reserved for the wealthy or those with vast sums of money, it's empowering to explore practical strategies that start small but hold significant potential over time. One such strategy is investing just $5 a week, a manageable commitment that can grow steadily without demanding drastic lifestyle changes or financial stress. This approach challenges the old mindset that you need a hefty upfront investment to make a meaningful impact. Instead, it emphasizes consistency, patience, and the power of compounding, which can turn modest weekly contributions into a substantial nest egg over the years. For beginners, the right platform can make all the difference in transforming that small weekly commitment into a smooth, educational, and rewarding journey. Take Robinhood, for example, a platform that has disrupted the investment world by removing barriers like broker fees and minimum investment amounts. Robinhood's interface is intuitive, welcoming those who might otherwise be overwhelmed by traditional brokerage firms. Its offering of fractional shares, where you can buy a piece of a high-priced stock rather than a whole share, makes investing accessible and flexible. Being able to start with as little as $1 truly democratizes financial participation, allowing anyone to dip their toes into the market with minimal risk. Another innovative player in this space is Acorns, which embraces automation and simplicity to make investing almost effortless. It rounds up everyday purchases to the nearest dollar and invests that spare change automatically. This method is particularly attractive to novices who might shy away from manual intervention or complicated decisions. The platform's pre-configured portfolios provide a structured approach tailored to different risk tolerances and goals, removing guesswork for beginners. By allowing people to start with mere cents, Acorns builds a bridge between everyday habits and long-term wealth building, turning what might feel like pocket change into a meaningful financial habit. Stash further complements this landscape by blending education with thematic investing. Not only does it enable users to invest with as little as $5, but it also guides them through the complexities of the market with integrated financial lessons. This educational aspect can empower users to make smarter choices and better understand what they're investing in. Plus, Stash's focus on theme-based portfolios like green energy or technology innovation adds a layer of personal engagement, letting investors align their money with their values and interests. This thoughtful approach adds depth and purpose to small weekly investments, making the process richer and more meaningful. Each of these platforms shares a commitment to lowering entry barriers, making investing approachable, and nurturing financial literacy in tandem with action. The recurring theme is clear. It is not about how much money you start with, but about establishing consistent habits and leveraging tools designed to support newcomers. The result is a more inclusive financial landscape, where individuals, regardless of their starting point, can build confidence and competence over time. These platforms, each with their unique features, collectively illustrate how technology has revolutionized access, making investing not just feasible, but inviting and engaging. As we reflect on these options, the transition from skepticism to empowerment becomes tangible. Starting small with just $5 a week may seem humble, but with the right guidance and tools, it sets the stage for a transformative financial journey. It invites us to rethink traditional narratives and embrace a new, democratized investment culture where everyone can participate meaningfully. This evolving landscape encourages us to move beyond fear and hesitation, offering a practical path forward that's accessible and well-supported. It's an invitation to begin, learn, and grow, step by step, dollar by dollar. Continuing from the empowering concept of starting small with weekly investments, it is essential to pair that commitment with a sound and secure investment strategy, one that aligns with a conservative risk profile yet offers steady growth potential. For many American investors seeking a balance between safety and opportunity, a thoughtfully constructed portfolio often centers around exchange-traded funds, ETFs. ETFs provide an elegant solution. Low-cost, diversified exposure to broad market segments, which mitigates risk while capturing market upside. This approach serves as a cornerstone in building a resilient financial foundation. Consider ETFs like the Vanguard Total Stock Market ETF, known as VTI, which offers vast exposure across the entire American equity market. By investing in VTI, investors gain access to thousands of stocks spanning small, mid, and large-cap companies. This automatic diversification reduces the impact of individual stock volatility and helps smooth out market fluctuations. This broad brushstroke approach allows even conservative investors to participate in the overall growth of the U.S. economy without betting heavily on any single company. The simplicity and breadth of VTI resonate with beginners seeking stability without sacrificing opportunity. Another popular choice is SPY, the SPDR S&P 500 ETF Trust, a fund that tracks the performance of the 500 largest U.S. companies. This ETF delivers exposure to well-established giants in a wide range of industries, providing a solid and seasoned portfolio base. For the cautious investor, SPY represents a tried-and-true path, offering a middle ground between risk and reward by focusing on these blue-chip stocks. Over decades, the S&P 500 has shown resilience and growth, making an investment in SPY a strategic component for building long-term wealth cautiously. What makes ETFs particularly appealing for conservative investors is not only their diversification or accessibility, but also their cost efficiency. Management fees on ETFs like VTI and SPY are minimal compared to actively managed funds, meaning more of your money stays invested and working for you. This low-cost advantage is critical over the long haul, as fees can quietly erode returns if not carefully managed. The structural simplicity of ETFs complements the philosophy of steady, patient growth, emphasizing prudence and discipline rather than chasing quick gains or speculative bets. Integrating these ETFs into a portfolio that prioritizes security also means being mindful of asset allocation. Allocating around 70% to ETFs, such as VTI and SPY, effectively anchors the portfolio in a diversified equity base, providing exposure to growth while managing the overall risk level. This allocation invites investors to lean into the power of the stock market's long-term trajectory without overexposing themselves to volatility. When paired with other, more conservative or income-focused assets, this strategy reflects a balanced approach tailored to the comfort levels and goals of cautious but opportunistic investors. This thoughtful model underscores the importance of blending accessibility, cost efficiency, and broad market exposure within a conservative framework. ETFs represent a versatile building block, one that adapts well to different financial goals while maintaining a steady course through the market's inevitable ups and downs. As we continue exploring this approach, the next natural step involves understanding complementary assets that fortify this portfolio's stability, further smoothing the pathway for investors to build confidence and grow steadily over time. Building upon the foundation of a diversified, conservative portfolio anchored in ETFs, it is vital to recognize the role of other asset classes that provide stability and strategic growth potential. After allocating approximately 70% of the portfolio to broad market ETFs like VTI and SPY, the addition of fixed income investments offers a complementary layer of security. Fixed income assets, constituting around 20% of this model, are prized for their low risk and predictable returns, characteristics that appeal to investors prioritizing preservation of capital alongside steady income. Treasury bonds and notes, backed by the full faith and credit of the U.S. government, are classic examples of fixed-income investments that provide a safe haven during market volatility. These instruments promise to pay interest at regular intervals and return the principal upon maturity, making them a reliable source of predictable cash flow. For investors concerned about economic downturns, treasuries serve as a bedrock, helping to cushion portfolios from the unpredictable fluctuations typical of equity markets. Their role in a conservative portfolio is fundamental, reinforcing stability without sacrificing all growth potential. Certificates of deposit, CDs, further diversify the fixed income segment by offering guaranteed returns over a set term through banks or credit unions. Their safety is backed by federal insurance up to certain limits, adding an extra layer of security for cautious investors. While the fixed yields on CDs may be modest compared to equities, they provide peace of mind and a disciplined savings mechanism. CDs can hold their own during economic uncertainties, complementing the overall portfolio's balanced risk profile and anchoring it with steady, assured gains. Treasury inflation-protected securities, or TIPS, introduce an important nuance to this fixed income allocation: protection against inflation. With inflation gradually eroding purchasing power, TIPS adjust their principal value based on changes in the consumer price index, ensuring that the real value of the investment keeps pace with rising costs. This inflation hedge appeals particularly to retirees or conservative investors who want to maintain their capital S buying power over time. Including TIPS within a fixed income allocation enriches the portfolio's defensive strategy, balancing security with a responsiveness to broader economic conditions. Rounding out this conservative investment model is the inclusion of a speculative yet small allocation to crypto assets, approximately 10%. While cryptocurrencies like Bitcoin, BTC, and Ethereum, ETH, are highly volatile and relatively new compared to traditional financial instruments, they offer unique growth opportunities and diversification benefits. This modest exposure acknowledges the evolving landscape of digital assets and the potential for outsized returns, while containing risk through limited portfolio weight. In this way, crypto functions as a calculated experimental segment within an otherwise grounded investment strategy. Including crypto assets also exemplifies a forward-looking attitude, embracing innovation and adapting to changing financial paradigms without abandoning caution. It is a delicate balance, recognizing the excitement and growth potential brought by decentralized currencies while maintaining a portfolio that's primarily focused on stability and long-term wealth preservation. As investors navigate these emerging asset classes, keeping this speculative slice small allows for participation without jeopardizing the portfolio's conservative integrity. The interplay of ETFs, fixed income, and crypto thus illustrates a nuanced, thoughtful approach, marrying tradition with innovation to build a diversified, resilient portfolio suited for today's complex market environment. Building on a robust, diversified portfolio framework, it is essential to acknowledge that investment success isn't solely about the money you put in or the assets you choose. Equally critical is the journey of education and gradual confidence building, especially for those just starting out. A practical 5-step action plan tailored for beginners helps bridge the gap between theory and practice, ensuring that new investors not only take the first steps, but do so with a grounded understanding and clear routine to support ongoing growth. The first and arguably most impactful step is education. Immersing yourself in financial knowledge creates the foundation for smarter decision-making and sustained commitment. Fortunately, the wealth of free resources available online today is unprecedented. Online courses from reputable platforms provide structured learning paths without any cost, democratizing access to high-quality financial education. Complementing these courses, YouTube channels like From Book to Life offer engaging, digestible content that breaks down complex concepts into relatable narratives, fostering better understanding and inspiration. Podcasts focused on personal finance add another dimension to this educational journey. Their conversational format and accessibility make financial topics easy to absorb during daily routines, whether commuting, exercising, or relaxing at home. These auditory lessons often bring on experts and real-life stories, which can personalize financial lessons and create a sense of community among learners. The combination of courses, videos, and podcasts creates a multi-pronged approach that caters to diverse learning styles and keeps motivation high. With education underway, the next essential step is the setup phase. Downloading an investment app might seem straightforward, but it marks a crucial transition from theoretical knowledge to actionable practice. Platforms like Robinhood, Acorns, or Stash are designed to simplify this process, guiding users through account creation and identity verification with user-friendly interfaces and clear instructions. This streamlined setup removes friction, allowing beginners to overcome initial hesitations and get started confidently. Starting conservatively is the wise strategy to embrace once your account is set up. Investing just $5 a week keeps commitments manageable while building a habit, one of the most powerful tools for long-term financial success. Automating these contributions further removes barriers, ensuring consistency even when life gets busy or distractions arise. This steady rhythm allows your portfolio to grow incrementally and reduces the temptation to time the market or make impulsive decisions. Reinvesting dividends, meanwhile, amplifies the power of compounding by putting returns back to work continuously, turning passive income into active growth drivers. Together, these 5 steps, education, setup, conservative start, automation, and reinvestment, create a systematic, supportive pathway for beginners. They encapsulate a philosophy that investment mastery is not about speed, but about steady progress, incremental learning, and practical action. This plan acknowledges the real challenges new investors face while providing a clear, achievable framework to move forward with confidence. Embracing this approach encourages a shift from hesitation and fear to empowerment and growth, nurturing a sustainable relationship with personal finance that can last a lifetime. As you establish your foundational investment habits, the journey naturally evolves into a phase of active monitoring and thoughtful growth. Checking in on your portfolio, as progress on a monthly basis, is more than a routine. It is a vital practice that reinforces discipline and awareness while helping you stay connected to your financial goals. This consistent review allows you to appreciate the incremental gains, understand market fluctuations, and assess whether your investments are aligned with your evolving objectives. It fosters a sense of ownership and responsibility, transforming the abstract notion of growing wealth into something tangible and real. However, amidst the inevitable volatility of markets, resisting the urge to panic sell is crucial. Impulsive reactions to short-term downturns can sabotage long-term success, turning temporary losses into permanent ones. This self-control not only preserves capital, but encourages a mindset grounded in patience and resilience. By keeping the bigger picture in mind, investors learn to navigate uncertainty with calmness rather than fear, understanding that markets have historically trended upwards over time. Avoiding knee-jerk decisions becomes a cornerstone habit, safeguarding your portfolio's integrity through cycles of optimism and downturn. Maintaining consistency, both in contributions and mindset, is equally important. The real power of investing lies in the compounding effect, which depends on regular, uninterrupted engagement. This steady commitment creates momentum, even in small increments, reinforcing financial discipline and building confidence over time. It's an investment rhythm that weaves seamlessly into one's lifestyle, making wealth accumulation feel attainable rather than overwhelming. This ongoing consistency also serves as a buffer against emotional volatility, providing stability during uncertain periods. Once a stable rhythm and basic understanding are established, it's time to think about escalating your investment strategy. Increasing your contributions gradually as your income or confidence grows is a natural next step. This escalation allows your portfolio to expand sustainably without disrupting your financial stability. It reflects a pragmatic approach, acknowledging life's changing circumstances and encouraging incremental improvement rather than drastic leaps. This phase respects both the practical constraints and ambitions of the individual investor. Diversification becomes increasingly important as you scale your investments. Broadening your portfolio across different asset classes, sectors, or geographical regions not only tempers risk, but uncovers new growth opportunities. It's a strategic move that builds resiliency into the portfolio's architecture, cushioning against market shocks in any one area. This expanded diversification aligns with evolving knowledge and financial maturity, representing a more nuanced understanding of risk and reward that comes with experience. Finally, the path of learning remains open and vital throughout this journey. The investment landscape continuously shifts with new instruments, economic trends, and technological advancements. Staying curious and committed to ongoing education ensures that your strategy adapts intelligently over time. Whether through deeper research, advanced courses, or engagement with financial communities, expanding your expertise allows you to refine your approach and seize emerging opportunities. This evolving mindset transforms investing from a one-time event into a lifelong dynamic process of growth, self-discovery, and financial empowerment. Transitioning from the tactical steps of monitoring and scaling investments, it becomes evident that the greatest asset an investor possesses isn't just their capital or strategy. It is the mindset they cultivate throughout the journey. Developing a resilient and patient investor's mindset is paramount, as it shapes how one navigates the inevitable highs and lows of the market. Patience, above all, stands out as a virtue that allows investors to look beyond short-term noise and focus on the long-term horizon where true growth occurs. This patience acts as an anchor, grounding decisions in perspective rather than emotion. Equally, consistency often trumps the size of the initial investment. It has a profound concept that challenges many ingrained beliefs about what it takes to succeed with finances. By contributing regularly, regardless of the amount, investors build a steady engine for growth that compounds over time. This ongoing commitment fosters a sense of discipline that, more than luck or timing, drives lasting financial progress. The power of consistency transforms modest beginnings into substantial outcomes, proving that the journey itself holds more importance than the starting point. In this continuous process, making mistakes is not only inevitable, but essential. Errors provide invaluable lessons, each misstep offering a glimpse into better strategies or deeper self-awareness. Embracing these moments with a reflective attitude turns failures into stepping stones rather than setbacks. This growth mindset fosters resilience and flexibility, encouraging investors to adapt, learn, and refine their approach without fear of imperfection. Understanding that missteps are part of the learning curve demystifies the process and encourages a more forgiving and proactive stance toward investing. Continuous education is the linchpin that supports and enriches this mindset. In a landscape that evolves rapidly, from shifting market dynamics to technological innovations, investors committed to learning stay equipped to make informed decisions. Whether it's through reading, online courses, podcasts, or engaging with financial communities, ongoing education cultivates confidence and sharpens judgment. It empowers investors to move beyond surface-level understanding and develop the depth required to navigate complexity with clarity. Together, these elements, patience, consistency, embracing mistakes, and ongoing learning, compose the psychological framework that separates successful investors from the rest. They encourage a steady, thoughtful approach rather than reactive behavior, placing emphasis on growth as a process rather than an event. This mindset nurtures perseverance over haste, wisdom over impulsiveness, and long-term vision over short-term gratification, all crucial in navigating the often unpredictable world of investing. As this perspective takes hold, it reframes the entire investment experience. Investing shifts from a source of anxiety and uncertainty to a meaningful journey of personal growth and financial empowerment. It offers a pathway where challenges become opportunities. Routine actions build future security, and knowledge becomes the cornerstone of confidence. This mindset doesn't just help investors manage their portfolios. It transforms how they engage with money, risk, and opportunity, fostering a healthier, more sustainable relationship with wealth. As we move deeper into the practical side of investing, it is crucial to pause and consider some fundamental safeguards that every investor, especially those just starting out, should take to heart. The financial markets offer tremendous opportunities, but they also carry inherent risks that can have real consequences if not approached wisely. One of the most important rules to internalize is never to invest money that you might need for emergencies. This might sound obvious, but it's an area where many people stumble. Having a dedicated emergency fund, kept separate and easily accessible, forms the backbone of financial stability. Without that safety net, the volatility of investments could force you to liquidate assets during downturns, often locking in losses you could have avoided if you had more liquidity on hand. Diversification flows naturally from this principle of protecting yourself. Rather than putting your eggs all in one basket, spreading your investments across different asset types, stocks, bonds, real estate, perhaps even emerging classes like cryptocurrencies, helps mitigate risk. Markets do not move in unison, and diversification ensures that a downturn in one sector or asset class can be balanced out by stability or gains elsewhere. This balanced approach doesn't guarantee profits, but it does reduce the chance of catastrophic loss, aligning well with a measured, long-term investment strategy. The wisdom here is to build resilience into your portfolio instead of chasing quick, high-risk wins. This ties directly into the next essential caution. Only invest what you can afford to lose. In the excitement of getting started, it's tempting to pour large sums into promising opportunities, but the cold reality is that no investment is risk-free. Being mentally prepared for the possibility of losing some or all of your invested capital is crucial. This mindset frees you from anxiety-driven decisions and allows you to approach the market with a clear, rational perspective. When your stakes are manageable, you can weather the inevitable ups and downs with greater balance and focus, keeping your long-term goals in sight rather than reacting impulsively to short-term volatility. At the same time, managing expectations realistically forms a critical pillar of successful investing. The public often sees stories of rapid wealth accumulation or overnight successes, which can distort perceptions about how investing actually works. Real growth usually comes from steady, disciplined efforts over time. Expecting unrealistic returns or trying to time the market perfectly sets you up for disappointment and poor decision-making. Instead, embracing a longer horizon, understanding that compounding gains accumulate slowly but surely, helps you maintain motivation and patience throughout the journey. This patient outlook becomes your anchor during inevitable market fluctuations, reinforcing the importance of discipline and calm. Transitioning from these foundational alerts, the practical step-by-step checklist builds a bridge from mindset to action. Choosing an investment app tailored to your needs marks your entry point into the investing world. Today's digital platforms simplify access to a broad spectrum of assets, making it easier than ever to start. Creating an account is straightforward, but it's the commitment to input that launches the process. Establishing a modest weekly contribution, even as little as $5, emphasizes that investing isn't about starting big, but starting consistently. This small but disciplined habit plants the seeds for future growth, highlighting how accessibility can democratize investing. Beyond setting up your account and contribution, dedicating time to learning is non-negotiable for sustained success. Reserving even 1 hour a week to study financial markets, investment principles, and new trends steadily builds your knowledge base and sharpens your judgment. Setting automatic contributions turns discipline into automation, ensuring your investment routine doesn't falter due to forgetfulness or momentary hesitation. Finally, routinely monitoring your progress each month keeps you engaged and allows for timely adjustments in response to changing goals or market conditions. Each part of this checklist reinforces the mindset principles we've explored, creating a holistic approach to investing that connects awareness, action, and reflection seamlessly. The real lesson here is that the path to financial independence isn't about having a huge starting balance or knowing all the answers. It's about building the courage to begin, educating yourself along the way, and consistently taking small, smart steps. Rich Dad, Poor Dad teaches us that mindset is everything. Patience, steady progress, and learning from mistakes matter more than quick wins or perfect timing. As you leave today's video, I encourage you to take that first actionable step, however small, and commit to your own growth journey. Like this video, share your insights or questions below, and hit subscribe to stay inspired with more life-changing ideas from books like this. And remember, the transformation starts with you. Check out our other videos for more practical ways to turn knowledge into lasting financial empowerment.